Hi, I'm Ray Kang. I'm a commercial real estate broker, and I work with owners and investors of retail centers in Central and South Texas. What me and my team focus on is property specific advisory so that we can help our clients better understand what's happening in the market so they can make more informed decisions and better returns on investments. Among our services are investment sales and leasing. Weekend wrap up exists so that we could keep an eye on what's going on with the US consumer and retail. And we cover some macroeconomic news, some retail news, and some of our takeaways of what we're seeing. So let's start with economic news and what matters most for retail and retail real estate. So, first off, consumer sentiment. Americans are feeling a little bit better this month about their personal finances. The University of Michigan's latest consumer sentiment survey showed confidence rose to a 4 month high in January, although optimism is still down 25% compared to last year. The biggest improvement came from younger consumers who are starting to feel a bit more positive about their own financial situation. That said, most workers are still keeping an eye on the job market, and there's still a lot of uncertainty around whether things will improve meaningfully in the near term. One encouraging sign: inflation fears are easing. Consumers now expect the cost of living to rise roughly 4.2% over the next year, which is the lowest reading in nearly a year. And that matters because inflation expectations can quickly become reality. When people and businesses expect higher prices, spending and pricing behavior can adjust accordingly. So sentiment is improving, but the consumer is still cautious. People are watching prices closely, staying aware of job security, and making spending decisions with more intention than confidence. Next up is this a consumer checkpoint piece from Bank of America: choppy start, solid finish. So American spending patterns are shifting. Consumers are still spending more month to month, but what they're spending on and who's driving it is changing. The data showed total credit and debit card spending per household rose 0.5% last month and is up roughly 1.8% from December 2024. Holiday spending also came in higher, up around 4.7% year over year, but that's not adjusted for inflation. And a meaningful part of that increase appears to be higher prices rather than more volume. Transaction counts are down. The average household made about 1% fewer holiday purchases than last year, which tells you consumers are being more intentional and selective. Category wise, travel and electronics softened while restaurants and clothing saw gains. That likely reflects a mix of people choosing experiences and social spending while also doing some reset shopping like wardrobe essentials and mall traffic. Bigger theme, though, is the income split. Higher income households continue to drive most of the growth, while lower income households are tightening up. Upper income spending climbed roughly 2.4% in 2025, while lower income households were only up about 0.4%, and they lean toward smaller ticket purchases. That lines up with wage trends too. Higher earners saw pay grow around 3% versus roughly 1.1% for the lowest third. The consumer isn't gone, they're just splitting into two different realities, and retailers are responding accordingly, either leaning into premium customers or doubling down on discount driven strategies. Inflation picked up a bit in December, and main culprits were the ones that hit households the most: rent and food. The latest CPI report showed prices rose 0.3% for the month, and overall inflation is now running about 2.7% higher than a year ago. Now, that's a lot better than what we dealt with the last couple of years, but it still means the cost of living continues to creep higher. The biggest driver was shelter. Rent and housing related costs were up 0.4% in December and about 3.2% year over year. And food also moved higher, with grocery prices posting their biggest monthly increase since 2022, even though certain items like eggs have come down. Food overall is we're still running about 3.1% above last December. There were a few bright spots. Prices for used cars, household goods, and appliances declined, and core inflation, which strips out the most volatile categories, rose a more modest 0.2% in December. For most households, the takeaway is pretty straightforward. Expenses are still rising, but incomes are generally keeping pace. Wages increased again about 0.3% in December, and purchasing power is up roughly 1.1% over the last year. That said, if you're on a fixed income, or you're already tight on monthly budget room, this is still the kind of environment where you have to be more intentional with spending, especially as rent and food continue doing most of the heavy lifting. Now, lastly, we're starting to see more tension between economic policymakers and the administration, and it's creating a new layer of uncertainty around the interest rate outlook. Federal Reserve Chair Jerome Powell has said he's now under a criminal investigation tied to the Fed's $2.5 billion headquarters renovation after the Department of Justice issued grand jury subpoenas that could potentially lead to an indictment. Powell's position is that the investigation is being used as leverage, essentially pressure on the Fed to cut rates. Stepping back, the Federal Reserve sits at the center of the U.S. economy, and their job is to manage interest rates to keep inflation in check while supporting employment. And the reason the Fed is designed the way it is so those decisions aren't driven by short-term pressure. Powell's term as chair ends in May, but he remains a Fed governor through 2028. So depending on how this plays out, it could have real implications on who sets policy and how interest rates are handled moving forward. So this isn't just political noise. It matters because confidence in an independent Fed is a big part of economic stability, and it directly impacts borrowing costs across the board, from credit cards to mortgages to commercial real estate debt. Now, before we move on to retail news, I wanted to give a quick shout out to a partner of our channel, ShareScoops. ShareScoops is an AI-powered financial content platform built for advisors to help advisors and financial professionals communicate more clearly and consistently with their clients. They help turn complex economic and market data into content that's approachable and useful without spending hours every week writing or chasing headlines. So, if you're an advisor, broker, or institution looking to build trust, stay visible and educate clients more efficiently, they've created a discounted sign up link for this audience that you'll find in the description. So, make sure to check that out. Now, let's get into retail news and where retailers are leaning in. First up is artificial intelligence. According to reporting coming out of the National Retail Federation and Retail Dive, retailers are leaning into AI, not as a gimmick, but as a cost control and efficiency tool. AI is being used for demand forecasting, pricing, inventory management, and personalized marketing. So this is bigger than just AI is cool, and AI is also getting much more strategic in being put to use. It's a real structural shift in how retailers operate, and it will absolutely influence retail leasing. And so some of the implications I thought about for retail and retail real estate is retailers are going to get much more selective about locations. AI makes it easier to identify which stores truly drive profit and not just in sales. That means retailers can cut underperformers faster and double down on proven winners. Average sites become more vulnerable, and top tier sites become more valuable. Store footprints will continue trending smaller and becoming more efficient. Now, with better forecasting plus inventory optimization means less backroom space for inventory, right? Fewer markdowns and tighter merchandising. So many brands can hit the same revenue with fewer square feet occupied. So demand increases for well-positioned small shop space and the right size end caps and not oversized boxes. Leasing conversations will become more data-driven and less forgiving. Retailers will show up with sharper unit level performance expectations and will be less patient with maybe it works locations. Trade area quality, access, parking, visibility, and tenant mix matter more than ever, and leasing will reward owners who can prove traffic plus conversion. Expect more lease flexibility pressure. So when retailers can adapt faster, they often want the real estate to become more adaptable too. Shorter terms, more kick out language, more options, more cautious commitments. That's what I'm thinking. So you may see more negotiation around renewal options, termination rights, and performance clauses, especially for growth brands. Albeit we are in a very tight market right now with very little inventory. So I think there will be a balance, but as more inventory comes online in the future, we'll have to wait and see. Now, tenant mix strategy, and that will become even more important. Retailers who can personalize marketing and manage demand better will push into categories that win in today's consumer environment. Convenience plus service, QSR fast casual, health medical, beauty, discount value, specialty food and beverage. The best performing centers will be the ones built around visit frequency and not just stuff you buy. And this all comes down to asset value as that becomes more sensitive to store level performance risk. If retailers are quicker to optimize their fleet, vacancy risk can show up faster, which impacts NOI stability and buyer perception. Stronger leasing plus strong operational occupancy equals stronger cap rate narrative. Now, bottom line, AI is accelerating retailer decision making. And for owners and investors, that means the market will reward centers with durable demand drivers and punish locations that can't consistently perform. The good retail gets stronger, and the average retail has to work harder to stay relevant. Let's talk grocery expansion. Aldi announced plans to open 180 new US stores this year, continuing its steady expansion strategy. Grocery remains one of the most durable retail categories, especially in value oriented formats. For retail centers, this reinforces the importance of daily needs traffic drivers. Grocers like Aldi support surrounding tenants and tend to perform well even when consumers are cautious. So when they push 180 new stores in one year, it usually reflects a few realities. Consumers are still spending, but they're more price sensitive. Groceries holding up as a must-have category. Discount slash value players are gaining market share, and people are actively trading down from higher cost grocery options. And that even includes higher income households who are doing this. So this is value is winning, showing up in retail real estate strategy. TGI Fridays, they just unveiled plans targeting 1,000 locations globally by 2030, signaling renewed confidence in experiential dining. But these expansions are not scattershot. They're focused on markets and sites that can support the brand. Based on the reporting, TGI Fridays is pushing a comeback plus growth narrative with its 1, 2, 3 strategic vision, targeting 1,000 plus restaurants and $2 billion in revenue by 2030. Now, first reaction, this is more about repositioning the brand than easy expansion. When legacy casual dining brands like Fridays talks about 1,000 locations, it's easy for us to just roll our eyes, but the real signal isn't the number. They're trying to rebuild relevance and reestablish their place in the market through menu changes, better guest experience, and upgrading the atmosphere. And that matters for retail real estate because it tells us restaurants are still a traffic driving category, but they have to be positioned as an experience, not just a meal. This move also reinforces a trend that we're already seeing. Food is the anchor for modern retail. Retail has shifted. Shopping centers used to be anchored by department stores, big apparel, destination shopping. But today, the anchor is more often grocery, of course, fitness, service slash medical, and restaurants and QSR. And Fridays is leaning into that by explicitly focusing on higher energy guest experience plus brand activation style events, not just come eat here. So, food and restaurant uses aren't just another tenant, they're often the best daily and nighttime traffic driver. Restaurants can be incredible. They generate visit frequency, longer dwell time, cross shopping, and evening and weekend traffic when other tenants are quiet. But of course, restaurants are operationally fragile, especially casual dining. They get hit by wage pressure, food cost inflation, shifting consumer demand, delivery or off premise behavior, and higher occupancy costs. So when Fridays says expansion, owners should hear we're going to be more strategic about the boxes and the economics. For their real estate angle, I think they're leaning into flexible formats. One of the most important pieces of this plan is that Fridays is talking about growth in non traditional and high traffic environments like airports and hotels. So that's significant because it reflects what's working right now: controlled environments, built in traffic, convenience based dining, and higher willingness to spend customer base. Now, with this, the bigger consumer story is experience still sells, but it has to feel worth it. Today, the consumer is still showing up, but I think they're more heavily asking now, is it worth the money? Is it worth the time? Is it better than at my at home option? Casual dining has struggled because it's kind of in the middle, more expensive than fast casual and quick service restaurants, but less premium than high end local concepts. So Friday keeps pushing their atmosphere upgrades plus experience improvements. And what they're basically saying is, we need to earn the visit again. So this Friday's expansion plan is less about casual dining suddenly booming again and more about brands fighting for relevance in a more selective consumer environment. For retail center owners, it's another reminder that food is one of the best traffic drivers we have, but the real value is in the right operators, in the right locations, with the right economics. So, to start the year, we've been working on multiple broker opinions of value and pricing analysis. Many of our clients who have held back over the past few years are now interested in understanding where values actually sit today and whether this is the right year to enter the market. We're also continuing to work with high growth retailers. Paris Baguette, we recently signed 2 leases and currently active on finding a few more sites. And with 10,000 Coffee, we're currently working on a deal in Chicago. Retailers are still growing and owners are re engaging with valuation and strategy. And 2026 is shaping up to be a year where planning matters more than just waiting. In our final segment, I usually bring up a topic, and this week is about the myth of buy and hold. I want to challenge that belief as I see it a lot with owners who carry that belief often without realizing it. They believe that buy and hold always wins. And historically, buy and hold ownership has worked. Over long periods, values tend to rise. Here's the part that often gets missed: buy and hold only works if you're measuring performance along the way. What I've seen repeatedly is that two owners can hold properties for the same amount of time and end up with very different results. One owner holds passively, rents lag the market, expenses creep up, capital decisions get deferred. The other owner holds intentionally. They track returns, adjust leases, reposition tenant mix, and make small changes that compound over time. When you compare those two paths using something like internal rate of return, the difference can be meaningful, even if both owners held the property for years. So, the new belief I want owners to consider is buy, hold, and measure wins. Not trade constantly, not react emotionally, but stay engaged enough to understand whether your capital is truly working as hard as it could be. The opportunity here is curiosity about how your property is actually performing and whether a few intentional decisions today could materially change your long term outcome. That's how disciplined owners quietly win over cycles. And that's this week's retail wrap up. Thanks so much for joining me. If you're thinking through value leasing or long term strategy for your property, you're more than welcome to reach out. Be more than happy to talk to you. If you ever have any comments or like to share some details of what you're seeing in retail, I would love to hear from you. Feel free to leave some messages in the comments. If you can like and subscribe, that would be super helpful as well. And I really appreciate that. Until next time, this was Ray Kang, and you have a great week.